Good afternoon, everyone. Thank you for tuning in. This webinar is brought to you by the CFA Society San Francisco, of which I'm proud to be a member. My name is Yanrong Chen, and it's my great pleasure to be your moderator today. Before we dive in, let me just quickly go over some logistics. This webinar will begin with the 30-minute moderated session where our speakers will walk us through some questions exploring India's digital economy and other underlying emerging markets, sharing research approach and insights on EM indexes and risk factors. That is the plan. And then following that, we will open up the floor for like a 10 to 15 minute Q&A session. I encourage you to type in your questions to the Q&A box, which we can monitor. Then as we go along, we will do the best to address all the questions, as many as we can. To ensure a smooth session, our audience will remain muted, and the webinar is being recorded. The replay will be shared with you and circulated beyond with you afterward. So, okay, without further ado, let's dive in. Today, we're very fortunate to have two expert speakers with us, both with extensive hands-on experience and deep knowledge of emerging markets. Their achievements are well known, and they hardly need any introduction. Let me see, we have from my left to my right, we have Jason, and to the right, that is Kevin. So, Jason, let's start. Maybe let's start with Jason. Jason, who is an award-winning researcher, a prolific academic, and entrepreneur. As the founder and the chairman of Rayliant Global Advisors, he's the leading voice on emerging markets. Jason, how about you start us off? Could you share your thoughts on the Indian's role in your broader EM strategies, like why India, why now?
So, I mean, obviously, a lot of people think of India as the next China. Now, clearly, the analogy holds at the level of they have about the same population. But in terms of the development, right, India is perhaps, a decade or so behind. If you just look at the export, India's export is only 1/8 of China's export. Now, level doesn't mean anything, right? It's the difference in level, meaning there is a great amount of growth that's available that's in front of India. Now, the question is, can India realize that potential? And my argument is, I think so. I think so. There is, I think a lot of similarity between kind of the Indians focus on education and Chinese education focus on education, and both love for making business and making a profit. So I believe there's tremendous growth that's ahead for India, making it quite exciting and interesting as an opportunity. So absolutely, it's a necessary part of an EM portfolio from the growth perspective. But I think one should be a bit more sophisticated than just thinking, oh, it has the same population of China, so it's going to be the next China.
Right, right. You already touched upon the India and China or India versus China, which we'll dive deeper very shortly. Thank you, Jason. And then on the left, the right of my screen, that is Kevin Carter. We have Kevin Carter, the founder and the CIO of EMQQ Global. Kevin has an incredible career journey and has made remarkable contributions to index investing and EM research. So, Kevin, as I gathered, you recently just came back from a trip to India. So could you tell us a bit about some striking or fresh experiences that you've gained from your time there, especially the part related to digital India?
Sure. Well, let me just first start by saying, why I think India isn't just an interesting emerging market. I think it's in many ways the perfect emerging market, and it's because as mentioned, it has the most people. And the case for emerging markets is lots of people, better demographics, faster growth, and consumption, and India is number one in all of those categories. And because of the scale of India, if you leave out China, India is bigger than every other emerging market combined. So this can really only happen once. It's also got incredible demographics. It's got fast growth, and that's driving consumption. And but then India also has a couple of other things that, set it even above and beyond, which is it has unmatched human capital, and it has its secret weapon, which is the digital public infrastructure, the India stack. And in terms of, my trip, I would say, it's pretty clear all of those things are happening. The physical infrastructure is mind-boggling to see. And I was only, I was there last year, and I've been going to emerging markets for 20 years, and I don't think there's anything I've ever seen that is like Mumbai today. And a lot of those, things are starting to come online, the infrastructure projects. So that remains, a big part of the story. And one of the reasons India's finally, arrived is because Modi doubled the infrastructure in the last 10 years. And then, one of the other, I guess the two main takeaways from the trip were first that there's a negative narrative around India where all the growth is happening at the very top. Like, yes, India's got a lot of people, but the only ones that can really afford a lot of this stuff are the people at the very, very top, and they live in the biggest tier one cities. But it's become very clear, and was very clear in my trip, that tier 2 and 3 are this whole story is spreading to tier 2 and tier 3, and it's spreading to tier 2 and 3 cities where the e-commerce growth is significantly higher than in the tier 1 cities. The wealth is spreading to second and third tier cities, and also the second and third tier entrepreneurs, the entrepreneurs that didn't go to IIT Delhi or IIM Ahmedabad. So I think that those were the main takeaways. And then the biggest takeaway from my trip is that there's something happening right now that is maybe one of the most disruptive things on the planet, and that is the arrival and quick ascent of so-called quick commerce, 10-minute delivery of anything, which is becoming quite disruptive, and it's quite early. So that's was by far my number one takeaway from this past trip.
Yeah, thank you, Kevin. I can sense the passion and also the observation that you see from the fast growth and the quick growth or quick come. That actually already touched upon our very first topic of today, that is India's digital landscape and its implication. As you also mentioned, the tier things first happen at top, but tier 1, 2, and 3 are coming up as well. We sometimes hear India as perfect market, or it has the potential as a rising digital powerhouse. As you also mentioned, they are quick commerce and low cost internet. So it seems everything is prepared, is ready. Now, what do you think? How far is India from fully realizing its potential? What does it take to close some gaps might be there so we can see a booming market?
Well, I mean, it is a booming market, that's for sure. As Jason pointed out, I mean, the scale of India is quite low versus the scale of China in terms of total GDP, in terms of GDP per capita. And while China might be an emerging market, it's the most developed e-commerce market on the planet by a long margin, and every day it gets further ahead. And so from a digital perspective, it's more like the Jetsons than an emerging market. And India, and this is one of the other big differences between China 15 years ago or 20 years ago and India today, besides just being the world's largest democracy as opposed to the communist country. When China was at this phase, nobody on the planet had a smartphone. And now, is India's arriving here, you can get a brand new pocket-sized supercomputer for $12 in India. and you have 5G coverage across the whole country. Not everyone's on it yet, but it's there, and you have low cost data. So in some ways, they're digitizing a lot faster, and um, and so that they're very advanced in some parts of the digitization, including again this digital public infrastructure, which no other country in the world has emerging or developed, and that again to me is I think kind of a secret weapon for India. But the e-commerce penetration numbers, the number of people that travel on airplanes, all of these categories, it's still very, very low relative to places like even Thailand, leave alone, France or a European country.
And I'll jump in and say, Kevin had mentioned, Modi doubled India's infrastructure spending, and that for us is absolutely critical. First of all, it's the infrastructure that allows, of course, all the smart devices to be connected to the world, and the world can begin outsourcing to India even more effectively, right? India being one of the largest software outsourcing, country in the world. But also, as the U.S. seek to force friendshoring, right? Force manufacturing away from China to more democratic shores, friendlier shores. India is a primo location, right? Foxconn, the biggest contract manufacturer, have begun experimenting manufacturing smartphone in India. Now, of course, the first experiment wasn't super successful, but just like when you first started to manufacture a lot of high-tech materials and then devices in China, the first batch wasn't perfect, right? It takes some iteration. So what's sort of necessary to attract more manufacturing to come to India to tap into the massive labor force to begin training and converting some of that less skilled labor force to sort of global standard high skilled labor force is you're going to have to build infrastructure, right? You're going to have ports. Of the 20 top ports, China accounts for 12, India accounts for one, right? If India was going to export more and then bring in more raw materials for value-added manufacturing, the port has got to get better, and there's got to be more of it. Roads, steady electricity, cheaper, clean water, right? And again, all of that is being built because Modi understands that's what it takes to grow and to converge and perhaps even over time overtake China. And so I think that is super, super promising, right? You're going to create a lot of wealth as you build infrastructure. But what's more important is with the building of infrastructure, attracting foreign capital, foreign direct investments, allowing you to export to the world, that will then begin unlocking the potential that is India.
So you're saying we don't need to wait for the entire ecosystem being built for India to take off, but the building that ecosystem itself is already a huge opportunity set. So investors can dive in. Great, Jason. I really like how our conversations flow like this. So it's not me robotically reading questions and then we answer. So you already touched upon my second question. That is, how can India's TMT sector drive growth across broader industries that you mentioned, the ports building and clean energy and water and things. So if you would like to add more, then we can stay on this topic a little bit, whether it creates opportunities to agriculture or pharmaceuticals, those. If not, then we can move on to next topic.
Yeah, well, I would say infrastructure is one, and obviously, everything surrounding the building of infrastructure becomes opportunity. But I would also say that, you know, uh, you know, there is one key difference between India and China, which is, broadly speaking, right? I mean, this is gross generalization. Uh, in China, like everyone pursues a high degree of education. It's almost like the national competitive sport, right? Doesn't matter what family, what socioeconomic background you come from, like you have the opportunity to compete in the sport, which is, study, take exam, and move up socioeconomically. I think that is more restricted in India. Right? I mean, I think it's better now than before. The caste system, though, still remains. And that means you do have a large uneducated population. And again, population in of itself is not beauty, right? It's sort of educated, hungry population ready to work, ready to be trained and become skilled and to be integrated into the global economy. And so I think India, if it continues to sort of evolve and improve on that front will accelerate this progression to sort of converge toward China as a global economic powerhouse.
Yes, yes. That's really exciting. Then, well, I see two of our speakers already touched upon China, India, and because these two leading markets always coming into a comparison. So maybe we can indeed zoom out a little bit on China, India comparison, but meanwhile zoom in with some focused questions. Maybe this one goes to Kevin first. Kevin is very familiar with this economy and how my question is, how does India's digital economy compare to China's? For example, China has dominant players, and how would you describe the market of India? Is it less consolidated or not? Or how do you view that?
Well, first of all, again, in terms of the size, China's e-commerce market is, you know, 30, 40, 50 times as big as India's. I mean, India's e-commerce as a percentage of retail spending is 5%. China's is 27%, the highest in the world. So India's it's very early. Um, in terms of the competition, the one thing that makes India different than China, well, there's a couple of things. A, there's no Chinese apps in India at all. They were all kicked out. And there's US apps and US owned apps that dominate. So both Facebook and Google are major players, as is Amazon. And in a strange way, so is Walmart because the homegrown Amazon called Flipkart is now controlled by Walmart. So now the two largest e-commerce companies are one Amazon, traditional e-commerce, one Amazon, the other one owned by Walmart, even though it's a local homegrown country. And India's done, certain things that are sort of protectionist. They've limited market share for the mobile payments market because Google Pay was growing too fast in their minds, and so it's definitely got more international competition. But the homegrown companies are really thriving. The Zomato, which is the DoorDash of India, but is so much more than just that. Uh, and again, I can't stress enough this quick commerce, again, which is basically 10-minute delivery of anything you want. This is sweeping the country and is still extremely early. And right now, traditional mom and pop stores, the Kirana stores in India, there's 13 million of them, and they represent 90% of consumer spending. I mean, that's how people spend their money at the mom and pop store that has 100 or 200 items. And Walmart, was putting a small ding in them, but all of a sudden, the three homegrown quick commerce companies, Blinkit, Zepto, and Swiggy, they are growing at an incredible clip and accelerating. And they've barely scratched the surface, but and so they're not just taking away market from the 13 million mom and pop Kirana stores, they're also taking market from Amazon. Because it's nice to get something tomorrow, but it's sometimes nicer to get it in 10 minutes. And these local homegrown companies have refined this business model to a point where it's exploding now and scaling at an incredible rate. It's uh, uh, it's one of the greatest pieces of commercial battling on the planet right now is happening on the streets of India's big cities as these three quick commerce companies roll out this new, which this has been done in other countries before, but it works quite well in India because it has low cost labor and a lot of two-wheeled vehicles and high density.
I see. So we're hearing an incredible growth story here in India. Then maybe on another topic, but still India and China or India versus China in terms of market inefficiency. which is often we come across for EMs. Maybe Jason can shed some lights on that. What's your take on the comparison of the two in terms of market inefficiency?
Yeah, so I think a lot of people naively think of market inefficiency as, well, if the stock market hasn't been around for a very long time, then it's a relatively inefficient market. If the price discovery mechanism isn't as robust, it's inefficient. I mean, that may be true, but it's not sort of useful inefficiency from an investment perspective, right? When you're managing a portfolio, what you really need is you need to have like a deep reservoir of basically uninformed capital to be on the other side of your trade. Right? And so if you look at a lot of emerging economies, right, they may be inefficient in the sense that their capital market hasn't been around for a very long time. They don't have really, experienced professional institutional money. But there also isn't a lot of sort of retail gambling in the stock market because there's too little sort of retail wealth. In that case, there's not a big enough reservoir for you to tap and benefit from that inefficiency. It's sort of almost too illiquid, even if it's inefficient, for it to be meaningful. And so that I would say is the biggest difference between India and China when you think about two inefficient markets, right? The Chinese stock market has been around longer than India's has, but it is still from a price discovery perspective probably equally sort of inefficient. But what makes China's market interesting is that it has a massive amount of private retail wealth speculating in it. So it wouldn't be incorrect to say there's sort of a casino aspect of it. And there's just a lot of retail individuals placing bets on a daily basis. And so if you're a disciplined portfolio manager, it's a quite large reservoir of alpha. And when you go to India, right, fewer stocks, a lot lower in terms of depth trading volume. So even though it's very inefficient, the ability to really deploy portfolio at size to benefit is lower, right? So that I think is just kind of the key difference between those two inefficient markets. Like one is just sort of a lot more shallow, a lot lower capacity, and it's really hard to deploy capital to tap that market.
I see. So we need more mechanism and tools to discover that price and to facilitate liquidity in that market. Then that
You're
also,
gonna have
yeah.
Yeah, and you have to be a lot more skillful in terms of like taking a model that sort of predicts inefficiency, but then invest
Mhm.
just, you know, carefully enough and skillfully enough to extract the alpha that you kind of see in your research.
That will be your secret sauce that we're gonna try to tap into a little as well. That leads us to our next topic. So I'm very curious and intrigued by the research methods when it comes to India markets. So we know Kevin is the Omaha school, and Jason is quant and quantamental approach. That's based on my research. So maybe we can first start with Kevin from a fundamental perspective. So Kevin, what considerations do you prioritize when analyzing India's economic growth and market potential, especially in the part related to the rapid digital transformation?
Sure. Well, let me say a couple of high level things before I go down into that.
Sure.
The idea of market efficiency, a, a lot of times that's in the discussion of, can the active managers beat the index, right? And that's, one of the most important sort of places where people apply that uh, thinking. And the one thing about emerging markets in India in particular is even if active management can add value, the costs of trading and other elements of India's cost structure for investors are pretty meaningful. And I know I haven't looked at the active versus index statistics, but usually the reason the indexing people win is because they have lower fees than the traditional active people. And I think that bears out in the case of India. And the other issue that I've had with emerging markets from the very beginning is that the indexes themselves have a lot of problems. And, you have companies in the world like Mercado Libre, which is now the most valuable company in Latin America that's not in the index. It's not in the Vanguard fund. It's the best performing, Latin American company. It's not included in any of the indexes, and it's not in the universe. So a lot of people, if you take the same universe as the index and apply a quantitative screen over it, you're still likely missing things like Mercado Libre, and you also have the state-owned enterprises, which were a huge problem in China when I got involved 20 years ago. It was 80% state-owned enterprises in the index. India doesn't have as much problem with state-owned enterprises. It's only about 10%. But another element of the India's stock market is some of the biggest companies don't get any revenue from India. So Infosys and TCS, and these might be fantastic businesses, but 95% of their revenue comes from the United States. And so they might be wonderful companies. They're publicly traded. They are in the India index. But if you're trying to tap into the growth of India, I don't think you're gonna capture that. And so, what I've, while I might be an Omaha person, I our strategies are, largely index based. There's a lot of leeway in defining what is an internet company. So we have some, discretion around the edges, but we're, buy and hold everything that's in the sector. And the reason we are so bullish on the internet sector, or new age tech, as they call them on the ground in India, is because this is the tip of the spear of growth. And, implicit in the term emerging markets is something's growing, and it's the consumer. And now that consumer is getting turbocharged by the $12 pocket-sized supercomputer. And so it's just the tip of the spear of where the growth is. And while, the revenue growth of the index is about 8 or 9%, which is the same as the GDP growth, I'm talking about the MSCI index, the internet companies have a growth rate that's 2.5 or 3 times that. And the other benefit of the internet companies in emerging markets is, because corporate governance is your biggest problem in emerging market, or one of them. And the state-owned enterprise is an example of that. The internet companies, and this isn't just in India, this is in Brazil and Korea and other emerging markets. The story is always the same. The smartest kid from every country goes to Harvard or Stanford or IIT Delhi, and then they go to work for Google or Microsoft, and then they go back to Harvard or Stanford to get their MBAs. And then they start an internet company, and they're funded by Sequoia or some other US institution. And that doesn't guarantee better corporate governance, but it's certainly, versus things like the Adani Group in India, it's a pretty good head start, because the capital formation of these companies has happened in the last 20 years, and it's had US institutions and their lawyers drafting the documents to form these companies. So it's where the growth is. There's better corporate governance. And from an investor standpoint, I mean, you don't have to look very far to see what's happening on the planet. You look at the FANG stocks that own our lives and our stock market, first on PCs, then on smartphones, still growing. In China, the equities haven't done well, but the internet companies have been the best ones, the same story. And now that story is spreading to the rest of emerging markets, and India, is amongst the other emerging markets. There's nothing else like it. So that's what I have to say about that.
I see. So Kevin has helped us to remind us of a similar to China path and the index-based approach. Also, the factors that you're considering is like sector-based, also corporate governance. Those are the things that you are taking into consideration when looking at companies, especially those new fresh internet companies. That's the next generation of India digital economy. Then maybe Jason can add the quant part to complement this approach. I know this quantamental. Yeah, I'm still trying to pronounce this, but that is the approach that I personally very into it. So my question is, what's your approach there to model India's dynamics? What specific data data sets or methods that you're gonna recommend? I listened to your another interview that you mentioned there EM that sometimes we have data sets that are not very useful for study, but not available in developed countries or elsewhere. So yeah, I'm not trying to steal your secret sauce, but just something that you can share with us.
Sure, absolutely, Enron. So indeed, fundamental is just a fancy way of saying we construct factors or signals that are based in fundamentals people can understand, right? So a lot of what Kevin was talking about, these corporate governance type analysis, right? That is foundational to sort of value protection in emerging markets. That's an important factor. And so we actually take things that we think have a high chance of working in emerging markets, and in India is a prime example. Right? India and China, in this case, are very similar in the sense that corporate governance is incredibly powerful. So funny thing is, if you take corporate governance and form factors around it and you apply it to the U.S., right, it doesn't do diddly squat because corporate governance, by and large, in the U.S. is pretty good, right? So any fine difference between this firm and that firm, right, it really doesn't show up in terms of future returns. But when it comes to corporate governance in India and broadly in the rest of emerging markets, what you see is firms that score high in terms of corporate governance produce more value for shareholders, meaning there's just a lot less of, management potentially siphoning off of resources or a controlling shareholder like the state siphoning off of resources. So corporate governance as a fundamental factor, when you quantify that and run a backtest, incredibly powerful. Something else that's not surprising would be, of course, anything that's like forensic accounting. Again, forensic accounting factors don't really work in the US because by and large, post Enron, companies don't play that game anymore, right? The cost of being caught is way too high, and now analysts are a lot wiser to that. Again, in emerging markets, accounting red flags are powerful predictors of future problems with firms. So you want to take all sorts of sort of forensic or forensic auditing, red flag type signals and apply that when you look at emerging market portfolios. And then I would say finally, because it is a, retail dominated market, so any type of behavioral biases tend to work well in India, like it does in other Asian emerging economies where there's just a lot of retail gambling in those markets. So, that's another factor that I think you want to use and formalize in those markets. And that's probably where you do get some proprietary data that exists in many EM economies that you don't find in the US. Are you able to identify trade flows because the stock exchange actually themselves, painstakingly identify flow as domestic retail versus domestic institutions versus foreign institutions. So you do get more granularity, and that increases your ability to do research.
Yeah,
Can I just add one other thing, kind of to add on to what Jason said? India right now is also experiencing a retail investment boom, and the number of retail brokerage accounts has gone from approximately 30 million to 120 million in a short period of time. And the problem that's happened is, one of the questions you sent earlier was about the market oscillating a little bit in India. The big index for India for the US investors is the MSCI, right? That's what the biggest iShares fund tracks. It has about 130 stocks. And, the PE is really high, but their earnings growth is pretty high too. So the PEG ratio is like 1.5, and it's, more expensive than other emerging markets, but it might be the best emerging market ever. So it probably deserves a premium. But the problem is there's 5,000 more stocks below there. And there's no doubt that this retail enthusiasm is there's crazy stuff happening in that lower part, and there's pump and dump stuff going on. And the worst part of it is the options trading. And I visited with the largest online brokerage in India is called Zerodha. And it's a private company. It could very well be a very large public company, but it was bootstrapped by two brothers that own the entire company, and they don't really have a reason to go public at this point. but over 90% of their profits come from retail investors trading Nifty 50 options. And so, there is a gambling mentality. And Jason's totally right. The China mainland market in particular is that is a casino market if ever there was one. But the Indian retail investor isn't necessarily speculating on stocks. They're trading options, which is a loser's game no matter what. And now but the other thing on the flip side, again, you touched on in some of the questions about fund flows. One of the other great things India has is domestic flows. And while they have a bunch of people, losing money trading options, you've also got millions of people that are starting monthly systematic investment plans. And the number of Indian investors that are saving 200, 500 rupees a month and putting them into index funds, that number has also exploded. So it's still early, but there's definitely retail, unwise retail trading activity that can be, capitalized upon by certain parties.
I see. Well, there are many nuances there in understanding this, and we already touched upon this Indian indexes. I think both Kevin and Jason talked about the complexity of indexes regarding India and the emerging markets, also the metrics that have influence on the inclusion and the weights of India in those indexes. Also, this is something on the spot I just thought of. We mentioned retail trading and gambling. Then that causes volatility, right? So then what's the interplay of volatility of Indian markets and the inclusion of India in those global EM indexes? How does the volatility can have impact on the change of India's role in those indexes? Can either of you share
Yeah.
it?
I mean, there's absolutely excessive volatility, and I think any market that is more inefficient with a lot more retail speculation, sort of more shallow, so news can have disproportional impact on price reaction. So in excess volatility is that true for India, true for China, which, like Kevin says, is actually much more developed. And in fact, if you look at South Korea, you look at Taiwan, right? Excess volatility is the name of the game there as well. Now, that's why you don't want to hold them as like a single investment, right? When you put it inside a portfolio, right? Either you buy India inside a emerging basket, or at least if you buy India as a single active portfolio, you should have, other active portfolio flanking around it to get diversification, right? So I think, if you diversify enough, that excess volatility really is a non-issue. And in fact, it is a source of active alpha if you're able to find someone who has the skill and pays attention to the cost that Kevin was talking about.
I see. Well. Oh, I see. I'm so into the conversations and I almost forgot the time. Actually, please indulge me just for the very last question. I'm using the privilege of the moderator here. Uh, To close our moderated session, then I think we have to talk about some risks. And because we hear the growth story of India, but on the other hand, we know India has this regional disparity, and cultural complexities. So this question is to you both, like for investors, how should we consider opportunities and risks? What type of instruments and strategies that we should use in order to gain exposure while trying to avoid or managing pitfalls?
Sure. Well, on my list of risks to India, I think that India has key man risk more than anybody. I think Modi is incredibly important to the India story today, and certainly in the last 11 years. And he's in many ways willed India and pulled up India, and he is the face and the embodiment of this renewed vibrancy and confidence that the country has. And I think hugely important. He's in good shape. He's 10 years younger than our current and next president. And I think he takes pretty good care of himself, but who knows what could happen in the world. And so, but eventually he'll be gone. But I think having him remain in the seat is pretty important. And he's just starting his third 5-year term, so that should continue. The country has a lot of history of ethnic and religious violence in the last 100 years, and it's always happening in small ways around the fringes of India, up in Manipur, in the northeast. There's ongoing problems, and one of the things they do when they have these problems is they turn off the internet, so the combatants can't communicate and figure out where to go battle the other guys, and so India leads the world in internet shutdowns as well. You have climate risk is very acute, and my last days in India were happened to be in Delhi when the AQI was over 1,000, and I think it got to 1,800 one day. And the heat and pollution is, it's an issue, and the low water levels in the southeast with
Oh.
rising sea levels.
Mm.
Corporate governance and things like Adani are a risk. And then the final thing, and this in many ways is perhaps the most important, and Jason touched on a little bit, but they need jobs. They have a lot of young people, like a lot more young people coming. They lead the world in birth rate by a lot, and they need jobs. And there's fortunately for them, there's a push to diversify from China, globally, the China plus one, whatever you want to call it. And India's well positioned to take advantage of that, but it has to happen. And they need the jobs, they need the manufacturing. They know this. This is part of what Modi's doing, is making it easier to attract jobs, and they've even set up their own, kind of free trade zone now in the gift city. So those are the risks I see. There's probably others that are, we don't know about right now that'll show up, but there's definitely risk, as there always is in emerging markets.
Yeah.
Well, I would say, Kevin mentioned, I think, all of the real economic risk. So I'll probably throw in one just to complement, which is, of course, is valuation, right? Kevin already mentioned India has the highest valuation
Right.
by quite a bit versus other parts of emerging markets, right? It is growing fast, but I think it's worth noting that, a lot of that growth is baked into the valuation. And so in many ways, it is pricing India as the perfect market. And anytime you're priced to perfection, I think there's risk, right? Any one of the risks that Kevin mentioned can knock, that growth off a projection and cause a cascading effect to the valuation as well, right? So you could have the fundamental and falling short of expectation, and then a valuation contraction as a result of that. So from an investment perspective, that's probably the biggest risk you face, right? If India somehow doesn't convert from this, friendshoring or U.S.-China decoupling, right, and the opportunity goes elsewhere to other parts of Southeast Asia, then a lot of what we're pricing in for India growth may not happen, right? I think if this massive democracy, and India's a bit on the extreme of, just having so many parties, right, the dysfunction of, the weird party coalition just to form a coalition, and the regional infighting as a result of that makes it sometimes hard to actually get things done. And I think that, to the extreme, could again be an obstacle on sort of India's road to emerge. Again, Kevin mentioning, right, India is still quite poor, has massive youth unemployment, and that youth unemployment can be beautiful if it becomes skilled labor and connect and service the world. But if the infrastructure and the economic policy isn't there to connect that unemployed youth with the rest of the world to become productive workforce, I think that population actually becomes a social problem. So again, it's up to this great democracy to put it together and convert.
Yes, we need justification for the high valuation, and we'd also need more live and the mechanism to connect all the dots. So in order for everything to happen more perfectly. I see we have some excellent questions already coming from the Q&A box. Let's see. First comes, first served. Then the first question is, can you talk about credit card penetration and how Gen Z shopping there? Maybe this question is for Kevin. It's made for Kevin.
Sure. Well, uh, consumer credit and small business credit in India are very, very, very low. And again, one of the great advantages or things that has happened in India in the last, 10, 12 years is the growth of this digital public infrastructure. And the main, the foundation of that, which is called Foundation, the Aadhaar database, that has brought, 800 million people into the banking system for the first time in a matter of 10 years. And because one of the problems that India had was nobody had identification. So it's hard to do a lot of things when you don't have an ID card or can't prove who you are. And certainly getting credit was one of those. But now they not only have a database, a digital database of everyone, they've also uh, converted, the vast majority of the economy is now digital. And so people have a digital track record of their entire financial lives. And one of the pieces of the India stack that they've recently added is the account aggregator, which allows consumers to apply for credit because they have their own sort of credit score based because everything they have coming in and out is now digitized. And because in India you actually own your own data, they can and it share their financial records in an encrypted way with potential credit providers and get access to credit. So credit cards and other forms of consumer credit penetration is very low. And if you look at like consumer credit in India versus Vietnam, for example, one of the reasons Vietnam's actually grown faster than India a lot in the last 10 or 15 years is because India's had a huge growth in consumer credit. So if India can get its consumer credit market, it doesn't have to get to US levels. If it gets to Vietnam's levels, that will add a lot to GDP growth. And the second part of the question is about Gen Z shopping. I just look at a Gen Z person here and you'll know what a Gen Z shopper in India looks like. I mean, the Indian smartphone users use more data than anybody at this point. So they're as smartphone centric all of a sudden as almost anybody on the planet.
Ready. Thank you, Kevin. And our next question from the audience is, could you talk about currency risk and the availability of tools to hedge that? Maybe we have Jason to start off on this one.
So I would say generally, if you are seeking to invest in India's growth, you really don't want to hedge off currency risk. Look, I recommend everyone to hold India as a strategic allocation in your portfolio. Again, as a satellite, fine, within a emerging ETF is a great idea as well. And if you're a long-term investor, there's no need to hedge off that currency risk. First of all, the equity market and the currency fluctuation are naturally diversifying against each other, right? So incurring additional costs to hedge off of what is perhaps already diversifying your equity exposure that you're buying in India is just extra cost with no benefits, first of all. And the second piece is there is a thesis that over time, holding emerging market currency, or at least currency in those markets that have a demographics, boom, tailwind is beneficial, right? You look at empirically, uh, every, I would say, at least Asian economy that emerged over time, right? Off of that demographic bonus and the emergence has always been a strengthening of the currency, right? And it's just a way of repricing the human capital, because they've gained skill and there's just more valuable human capital back in the economy, back in that currency. And so you really wouldn't want to hedge that opportunity off as well. So I would say, look, buy and hold emerging market exposures. Certainly India is one of them for the long run, and ride the currency as well. Don't see it as a currency risk, see it as a currency benefit that's actually diversifying against the equity risk you're taking.
So embrace it as a diversification tool, not get scared. Okay, beautiful. I think all No good conversations are too long, but we are already over time. We are running over. So this brings us to the end of today's webinar. We have covered a lot. We started with India's digital markets and transformation, the research, also index, and the China and India versus India comparison, investment strategies, and the risk and more. A huge thanks to both Jason and Kevin for such thought-provoking discussion, and also thank you to our audience for joining us and contributing with your great questions. Well, this is the holiday season, then I wish everyone a wonderful holiday ahead. Till next time, take care and bye bye.
And thank
Thank
you,
you.
CFA San Francisco. Bye bye.